Hi, this is your interest rate watch for Friday, September the 24th. Just a quick note to report that came out this morning was a housing report. Didn't quite meet the expectations of Wall Street, but overall didn't have a negative impact on the mortgage world or on the bond side. Well, we also want to put out a quick thank you to everyone that shared the link that we had yesterday in the call to action. We had a lot of great feedback and comments that came back from that, and the most important thing is I want to just say that I personally contacted Ben Sherman's office yesterday to ask him questions, and it was very interesting from one of his representatives in his camp is that these HR, House of Representatives bills, are not covered by media just because of the technicality and being able to explain that in a short, quick synopsis on media to put it out there to the public is very difficult. And that comes very interesting to us is that something that's this big that has a direct impact on housing, which obviously has a direct impact on our U.S. economic recovery, is not being put out there to the consumer, to the homeowners, to the future homeowners out there. So we ask in any shape or form that you share yesterday's link or you do your own research through the links that we provided and ask all of your friends and family, your social network, to definitely step up to the plate and contact their congressman or woman to show support for a bill like this. Secondly, we just want to touch on the overall news that came out this week. Can you say volatility? You know, we started interest rates higher at the beginning of this week, moving into the middle of the week with the Federal Reserve announcement. Quantitative easing is a big word that we just want to touch on really quickly. 2009, if you can remember, it was a volatile year in interest rates, and all the year you heard historical low interest rates, historical interest rates. Well, that continued into this year, even without the Federal Reserve purchase program, which ended in March of 2010 for that $1.2 trillion. Well, if speculations do come true from Ben Bernanke's announcement of quantitative easing, we could see another round of these bond buybacks from the government or / Federal Reserve. Now, what that would mean is we currently have been fighting what they call ceiling of resistance. And just think of it as if the average interest rate stays nationally at 4.374, I think is what we heard the other day. In order to break that level, that means that we have to have so many days of consistent average of interest rates going lower. And right now, we're fighting what's called a ceiling of resistance. And with that, there's no real information or economic data that's pushing interest rates lower. However, with this announcement that could potentially come in the November meeting, which we've been touching on, it really could push the ceiling resistance higher, resulting in lower interest rates for all the homeowners out there. So we just want to put that out there to everybody that that's something that we're going to definitely keep our coverage on and keep bringing to you as a homeowner. One other interesting fact that we read about this morning is that the fact of Wall Street. You know, right now the situation with Wall Street is they may be in a no-lose situation. And the reason for that is if any good economic news comes out, the Wall Street obviously benefits from that. However, with deflation and quantitative easing, well, that means that more foreign economies or foreign currencies are going to invest in Wall Street, creating Wall Street to go up even more. So it's very interesting that the standpoint that we're currently in with our U.S. economy. Wall Street's performing strongly comparing to the overall economy of the United States, and here they're almost in a no-lose situation. So it'll be very interesting because we haven't seen these times before, moving forward toward the end of this year, going into the fourth quarter, them talking about Christmas, and obviously starting off next year. All these reports are going to have a direct impact to you, the homeowner out there, and how interest rates are going to fluctuate. The biggest thing that we do want to put out is eventually inflation is going to kick in. If you talk to your tax advisor, your financial advisor, they're going to forewarn you that inflation will return, and it will return probably within the next 18 months. It's not going to be this sharp increase. However, interest rates, as far as they've come down, history has proven time and time again that they will go up. The timing is uncertain, but we definitely want to let you know that if you're watching this, you're sharing this information with others, you're receiving this for the first time, if you really want to get some good advice, team up with a tax accountant, a CPA, a financial advisor, and start asking them, what are their predictions? What are they seeing? What are they hearing from their side? And how they can better position you financially. Then you can gain the best education to figure out when is it the best time for me to take advantage of a refinance, purchase a home, or just overall regroup and look at where your financial picture is. That's just the best thing you could do at one of the cheapest times to borrow money. So we appreciate everyone that shared our links from yesterday. Please continue to share that. If any news breaks, of course, we will bring that to you. Make sure to follow us on our Twitter page. We'll be back on Monday with more news. Have a great weekend.